stop. Before you buy your next coin, this might save you a lot of money because chances are you're not losing money because of the market. You're losing it because of how you think. Have you ever caught yourself thinking this? You see a coin trading at just a few cents, and you think, if this hits $1, I'll be rich. Or maybe you're still holding a project, even though deep down, you already know it's dead. Welcome to the world of biases, mental traps, that quietly destroy your crypto portfolio without you even noticing. And by the way, this doesn't just apply to crypto. These biases affect every kind of investment, stocks, real estate, even business decisions. The only difference is, in crypto, they show up faster. In this video, we're breaking down 5 of the most dangerous psychological traps that keep costing crypto investors money over and over again. These affect everyone, beginners and professionals. Because your brain wants shortcuts, it wants fast decisions, especially in a market that moves fast, flashes numbers, and feels chaotic. But that's exactly what leads to bad decisions. And when emotions meet money, things get expensive. Let's start with one of the most common ones, unit bias. People love whole numbers. Owning one full coin just feels better than owning a fraction. So, instead of buying a small fraction of Bitcoin, many would rather buy thousands of XRP because it feels bigger. But here's the truth. The price of a single coin tells you nothing about its real value. What actually matters is market capitalization, the total value of all coins combined. Let's take April 2026 as an example. Bitcoin is trading at roughly $70,000 to $80,000 per coin. For this example, let's use a price of $75,000. Bitcoin has a maximum supply of 21 million coins. Most of them are already in circulation, with just under 20 million Bitcoin currently in circulation. The remaining coins will be released slowly over time through mining until the full supply is reached around the year 2014. At a price of $75,000 per Bitcoin, that puts the total market value at roughly $1.5 trillion. Now look at XRP. XRP has a maximum supply of 100 billion coins. And unlike Bitcoin, all of those coins were created from the start. However, not all of them are in circulation. A large portion is still held in escrow by Ripple Labs and released gradually over time. Each month, up to 1 billion XRP can be unlocked, but any unused portion is usually returned to escrow. In this example, XRP is trading at around $1 to $1.5 per coin, and there are roughly 55 to 60 billion coins currently in circulation. That gives XRP a market cap of roughly $60 to $90 billion. Now, here's the key point. If XRP went to $10, its market cap would rise to around $600 billion. And if XRP went to $100, we're suddenly talking about around $6 trillion. That would make it larger than Bitcoin at current levels, and larger than some of the biggest companies in the world. But even if more XRP enters circulation over time, that doesn't automatically increase the market cap, because increasing supply can also put pressure on the price. So, a $100 XRP, very unlikely. And that's the point. It's not about how cheap a coin looks, it's about how big it already is. The total market value is what really matters. Next up, FOMO, fear of missing out. This is probably the most dangerous bias in crypto. When everything is pumping, you feel like you have to be in. You see prices going up. You see people posting gains, and you think, if I don't buy now, I'll miss my chance. So, you buy, usually right at the top. Then the market turns, red candles, panic. And what do most people do? They sell. At the bottom. This is where people lose money, not because they don't understand the market, but because they feel too much. FOMO feels rational, but it's not a strategy, it's fear. And fear is a terrible advisor when money is involved. Next, confirmation bias. We all want to be right, so your brain searches for information that confirms your opinion and ignores everything else. If you believe a coin will go up, you look for bullish news, bullish tweets, bullish videos, and anything negative, you ignore it. You build your own bubble, a world where everyone agrees with you, and that makes you feel even more confident, even when you shouldn't be. Then there's one of the most expensive mistakes, hodl bias, also known as the sunk cost fallacy. This is when you hold on to a coin just because you already invested in it. You tell yourself, I can't sell now, otherwise it was all for nothing. But that's the trap. That money is already gone. The real question is, Would you buy this coin today at its current price? Not at your old price, today. If the answer is no, then you already know what you should do. But emotions get in the way. Hope, denial, ego. And that's why people hold, even when they shouldn't. And finally, tribalism. This is when crypto stops being an investment and becomes part of your identity. Bitcoin is the only real asset. Ethereum will take over everything. This is the next big thing. You pick a side, you defend it, and suddenly, it's no longer about facts, it's about belonging. But crypto is not a sport, and it's not a religion, it's technology. And technology evolves fast. If you get too attached to one project, you stop seeing new opportunities, and that can cost you a lot. These biases decide when you buy, when you sell, and when you panic. But once you see them, you start thinking differently. You stay calm, while others react emotionally. Because in the end, your biggest enemy in crypto is not the market, it's your own brain. If you want to survive the next pump or the next crash, remember this. Emotions are expensive. Knowledge saves money. If you enjoyed this video, leave a like, subscribe, and tell me in the comments which bias has caught you before.